Three things have happened in the gold market, and when you connect them, the picture becomes very difficult to ignore. Central banks have now bought more than 1,000 tons of gold for 3 straight years. Official sector demand has climbed to more than 1/5 of total global gold demand, roughly double the share it held on average in the 2010s. And according to the European Central Bank, gold became the world's second largest reserve asset at market prices in 2024, behind only the US dollar. Those are not random data points. Those are signals. And by the end of this video, you're going to see why this is not just another gold rally. It looks much more like a long-term reserve shift happening in plain sight, while most of the financial media still treats gold like a side story. Because if this were only about inflation, the story would be smaller. If it were only about geopolitical stress, the story would still be important, but it would not explain the scale. And if it were only about investors chasing momentum, you would expect the buying to be more emotional, more temporary, more price-sensitive. But that is not what we are looking at. What we are looking at is a coordinated pattern across reserve managers, emerging market central banks, and global monetary authorities that suggests gold is being treated less like a trade and more like strategic monetary insurance. That distinction matters. Traders buy strength. Central banks build position. Traders care about next quarter. Central banks think in decades. And when decade-based buyers keep stepping in, they can create something every gold investor cares about, a price floor that is much stronger than the market seems willing to admit. Start with the most obvious signal. In full year 2024, according to the World Gold Council, central banks added 1,045 tons to global gold reserves. That was the third year in a row above 1,000 tons. Read that again. 3 straight years above 1,000 tons. Before this surge, the average pace over the prior decade was closer to 400 to 500 tons. In other words, the official sector did not just increase buying a little bit. It appears to have reset the demand regime. And when demand resets at the reserve manager level, the market structure changes with it. This is one reason gold demand hit a record annual total in 2024, while the average annual LBMA price also climbed to a record level. The price did not move higher in a vacuum. It moved higher while one of the least price-sensitive groups in the entire market kept accumulating. Now let me translate why that matters in plain language. A hedge fund can buy gold this month and dump it next month. A retail investor can panic buy or panic sell. ETF flows can reverse quickly, but central bank buying is different. It tends to reflect reserve policy, vulnerability management, and strategic asset allocation. That kind of buying does not disappear because the chart looks overextended for a week. It is far less sensitive to short-term noise. So when official buyers stay active into higher prices, that is the market telling you something important. This demand is not being driven by excitement. It is being driven by necessity, and necessity is usually much more durable than sentiment. Then ask the obvious question. Why now? Why has the pace stayed so elevated? The answer gets more interesting the deeper you go. According to the World Gold Council's 2025 Central Bank Survey, 95% of respondents expect global central bank gold reserves to increase over the next 12 months, and a record 43% expect their own institutions' gold reserves to rise. Not stay flat, rise. And none of the respondents expected their own gold holdings to decline. That is extraordinary. In markets, when almost everybody agrees on something, you usually get cautious. But in reserve management, that kind of consensus tells you institutions are responding to the same pressures at the same time. They are seeing the same vulnerabilities. They are reading the same map. And what pressures are they talking about? The World Gold Council survey and the ECB's own analysis line up on the major reasons: diversification, performance during crisis, inflation hedging, store of value characteristics, and a growing emphasis on geopolitical risk. The ECB went further. It noted that among emerging and developing economy, central banks, 1 out of 4, cited concerns about sanctions or anticipated changes in the international monetary system as factors shaping their gold exposure. That single detail is easy to skip over, but it may be one of the most important lines in the entire story. Because once reserve managers begin thinking about sanctions, access risk, and the possibility that traditional reserve assets could become politically complicated, gold stops being a commodity in the policy mind. It becomes neutral collateral. It becomes outside money. It becomes an asset with no foreign issuer attached to it. And that is where the hidden strategy starts to come into focus. The mainstream version of this story is that central banks like gold because inflation is high and uncertainty is elevated. That is true, but it is not enough. The deeper version is that central banks are trying to build reserves that are harder to freeze, harder to politicize, and less dependent on any one foreign government's balance sheet. A US Treasury is liquid, but it is also someone else's liability. A foreign currency reserve is useful, but it can be entangled in sanctions, payment systems, and shifting alliances. Gold is different. It does not need a promise from another country to remain gold. That is a huge distinction in a world where geopolitics has moved back to the center of finance. Now layer in another signal. The IMF's reserve data and IMF analysis continue to show the longer-term decline in the dollar's share of official foreign exchange reserves, even if the pace is gradual and exchange rate effects complicate the quarterly moves. The IMF's 2025 annual report put the dollar's share at about 58% in 2024, down from far higher levels in prior decades. That does not mean the dollar is collapsing. It does not mean a dramatic overnight reset, but it does mean reserve managers have already been diversifying at the margin for years. Gold fits perfectly into that trend because unlike shifting from dollars into another fiat currency, buying gold diversifies not just currency exposure, but political and institutional exposure too. In other words, this is not simply de-dollarization in the sensationalist sense. It is reserve risk diversification in a much more serious, institutional sense. This is also why the recent surge in official gold demand should not be framed as some isolated commodity story. It sits inside a much bigger reserve management story. If a central bank is worried about inflation, it may want more real assets. If it is worried about geopolitical fragmentation, it may want more neutral assets. If it is worried about reserve concentration, it may want broader diversification. If it is worried about financial sanctions, it may want assets under more direct sovereign control. Gold checks all of those boxes at once. That is what makes it so powerful in this moment. It is not solving one problem, it is solving several problems at the same time. And then you get to the part the media tends to underplay: who is doing the buying? The ECB noted that the recent accumulation has been concentrated in a relatively small number of countries, highlighting Turkey, India, and China among the largest purchasers since the end of 2021. The World Gold Council said Poland led reported central bank buying in 2024 with about 90 tons. India has also continued to build reserves, and the Reserve Bank of India reported that as of March 2025 it held 879.59 metric tons of gold, with gold's share of total foreign exchange reserves by value rising from 9.32% in September 2024 to about 11.70% in March 2025. Think about that for a second. In one of the world's largest reserve portfolios, gold was not just sitting there passively, its role was actively increasing. That matters because it shows this is not a purely symbolic accumulation program. Some of these countries are meaningfully changing the composition of reserves, not dramatically overnight, but meaningfully. And when several countries do that at the same time, the aggregate effect becomes large enough to move the global market. This is the difference between looking at a single central bank in isolation and looking at the pattern. One country buying gold can be a local policy choice. Multiple reserve managers buying aggressively over several years is a macro signal. Here is where the story gets even more interesting. The World Gold Council's own data showed total gold supply in 2024 rose only about 1%, even as total annual demand hit a record 4,974 tons. So on one side of the market, you have official buyers absorbing metal at a pace far above the prior decade average. On the other side, supply growth is modest. That is a very important imbalance, because if the demand shock were being met by a rapid surge in mine output, the bullish implications would be smaller. But that is not what the data shows. Supply is moving. It is just not moving with the same force as demand. And when a strategic buyer meets relatively sticky supply, higher prices become much easier to understand. This is the point in the story where many people say, fine, but gold always has a bullish narrative. Inflation one year, recession the next year, geopolitics after that. Why is this time different? The answer is that the official sector is no longer behaving like a marginal participant. According to the ECB, central bank demand accounted for more than 20% of global gold demand in 2024, versus roughly 1/10 on average in the 2010s. That is a structural shift, not just a narrative shift. And structural shifts are exactly the kind of thing broad audiences tend to notice late, because they unfold slowly until suddenly the numbers are too big to ignore. Now here is the mid-story detail that reframes everything. The ECB said that with both high prices and large official holdings, gold became the second largest global reserve asset at market prices in 2024, behind only the US dollar. Not the euro, not the yen. Gold. That means gold is no longer sitting at the edge of the reserve system as some historical relic that central banks hold out of tradition. It is moving back toward the center of the reserve conversation. And when something becomes that important inside the reserve system, markets eventually stop treating it like a niche hedge and start treating it like a monetary signal. That shift in perception can matter almost as much as the buying itself. Let me translate that again. If gold is the second largest reserve asset at market prices, then every major move in gold is telling you something not just about jewelry demand or speculative positioning, but about the architecture of trust in the financial system. Gold rises for many reasons, yes, but when it rises alongside sustained official accumulation, it can also be read as a vote on confidence, counterparty risk, and the durability of the current monetary order. That is why this story is much bigger than a chart. It is really about what institutions trust when the world becomes less stable, more political, and more fragmented. And if you think this is all too abstract, look at the practical behavior. India's half-year report on foreign exchange reserves showed not only a larger gold stock, but also that a growing amount of gold is held domestically. By March 2025, the RBI said 511.99 metric tons were held domestically, while 348.62 tons were kept with the Bank of England and the BIS, with the rest in gold deposits. That is not proof of panic, but it does reinforce the point that gold is being treated as strategic reserve infrastructure, not just an accounting line. The location, custody, and share of reserves all matter once countries begin thinking more seriously about resilience. And this is exactly where the hidden strategy label becomes appropriate. The strategy is not hidden because nobody can find the data. The data is public. The strategy is hidden because the pieces are scattered across official reports, reserve surveys, and dry institutional language that most people never connect. The media reports the price. Another report mentions central bank buying. Another article talks about sanctions risk. Another database shows the dollar's long-term reserve share declining. Another central bank quietly reveals a larger gold allocation. But when you stack those signals together, the conclusion becomes much more powerful. A growing number of monetary authorities appear to be rebuilding gold's role as a core reserve asset for a more fractured world. And this is why the paper versus physical conversation matters here, even if people sometimes use that phrase too loosely. When official institutions decide to accumulate gold as a reserve asset, they are not expressing a view on a ticker symbol alone. They are expressing a preference for the underlying asset itself. Real bullion, real reserve diversification, real collateral that is not someone else's promise. That does not mean futures markets stop mattering. They absolutely matter for price discovery and short-term volatility. But over time, persistent official sector accumulation can tighten the link between paper pricing and physical strategic demand. That is one reason gold can keep surprising people to the upside, even when short-term positioning looks crowded or overbought. The strategic bid underneath the market changes the whole tone. Another point that deserves attention is how broad the motivation base has become. This is not just about one fear, not just inflation, not just war, not just reserve diversification. Gold is benefiting from several independent motivations at once. It performs during crisis, it hedges inflation risk, it diversifies reserves, it carries no direct foreign sovereign credit risk, it can help mitigate sanctions exposure, and it sits outside the liabilities of the fiat system. When one asset solves multiple institutional problems simultaneously, demand can remain strong, even when any single narrative temporarily cools down. That is part of why official buying has remained so resilient. Even if inflation eases, the geopolitical argument remains. Even if geopolitical headlines cool for a moment, diversification remains. Even if rate expectations shift, reserve management logic remains. Notice what that means for investors. If you are still viewing gold only through the lens of Fed cuts, CPI prints, or recession timing, you may be looking at too small a frame. Those things still matter, of course they do, but the bigger signal may be that central banks are helping create a new base level of demand underneath the market. In other words, the cyclical drivers still move price in the short term, but the structural drivers are doing more of the heavy lifting than many analysts admit. That does not make gold a straight line higher. Markets never move that way, but it does mean pullbacks may need to be interpreted differently when the official sector is still broadly constructive. And here is another overlooked angle. OMFIF's 2025 Global Public Investor Survey found that 32% of central banks expect to increase gold holdings over the next 12 to 24 months. That is a separate survey from the World Gold Council, and it points in the same direction. Two different institutional surveys, same broad message: reserve managers still want more gold. This is exactly the kind of convergence you look for if you want to know whether a trend is real. One survey can be noise. Two different surveys confirming the same direction is much harder to dismiss. Now, does any of this mean gold replaces the dollar tomorrow? No. And serious analysis should not say that. The dollar still dominates official reserves, global trade invoicing, and financial plumbing. But that is not the standard that matters for this video. Gold does not need to replace the dollar to matter more. It only needs to absorb a growing slice of reserve demand at the margin. And that is exactly what appears to be happening. In macro, the marginal change is often the real story, not whether the old system disappears tomorrow, but whether institutions begin preparing for a world in which they trust that old system a little bit less. A little bit less trust, multiplied across dozens of reserve managers, can produce a very big move in one market over time. And once you see that, the last few years in gold start to look less mysterious. Record prices, record official sector demand, strong investment interest. Gold reasserting itself in reserve portfolios. None of these are isolated events. They are parts of the same macro narrative. The hidden central bank strategy driving gold prices higher is not a secret plan in a dark room. It is a visible shift in reserve behavior that most people underestimate, because it arrives through technical reports instead of dramatic headlines. Central banks are not buying gold because they think it sounds nostalgic. They are buying it because in a world of inflation shocks, war shocks, sanctions risk, and reserve fragmentation, gold still does something very few assets can do. It sits outside the promised structure of the system while remaining globally recognized, liquid, and politically durable. So when people ask whether gold is overextended, that may be the wrong first question. A better first question may be this: has the official sector finished repricing the importance of gold inside the reserve system? Because if the answer is no, then what looks expensive on a short-term chart may still be cheap relative to the role gold is starting to play again. That is the deeper signal here, not that gold goes up every day, not that every rally is justified in a straight line, but that the world's monetary authorities seem to be telling you, through their own balance sheets, that gold is more important than the conventional narrative still assumes. And this is why people who pay attention to the signals early have an edge. Most investors wait for the story to become obvious. They wait until the headlines are clean and the narrative is widely accepted. But by then, the repricing is often well underway. The real opportunity is usually in the messy middle, when the data is already changing, but the mainstream framework has not caught up. That is the phase we appear to be in now with gold. The official data is there, the buying is there, the reserve surveys are there, the geopolitical logic is there, the supply constraint is there. The only thing missing is broader recognition. So where does this go next? Does central bank demand keep putting a floor under the market? Does reserve diversification continue even if inflation cools? Does gold's larger role inside official reserves eventually force a broader re-rating by mainstream allocators who have stayed underweight? Those are the questions that matter now, because once you understand that this is not just a speculative move, but a strategic reserve trend, you start looking at the entire market differently. And I want to hear your view on this. Do you think central banks are still early in this gold accumulation cycle? Or do you think most of the big reserve shift is already behind us? If you're watching these signals before the broader narrative catches up, subscribe and stay with us here on Safe Haven Metals. Because this is exactly what we cover every day: the hidden macro shifts, the institutional behavior, and the market signals that tell a much bigger story than the headlines do.